Welcome to Empowered to Grow, the podcast. I am your host, Hanan El-Basha. Hello, everyone, and welcome to a new episode of Empowered to Grow in Business podcast. I'm really excited about this episode because it's everything I love to talk about, which is a lot of topics, as you would know by now. But today we're going to be kind of breaking down some elements of the Founders Playbook. And these are topics that are not really in the spotlight, or they don't get the headlines as much as we would love. And this is what kind of started my conversation, or what my conversation with Curtis revolved around when we met briefly in Doha. And it was a very, very prosperous conversation. And this is how we're doing the podcast together. So without further ado, please allow me to introduce my guest for today, Curtis Bergh. Hi, Curtis.
Hi, good to see you again.
Thank you. Thank you
it
for
it was just like, yeah. No,
Yeah.
It's great to be here. It was just 3 or 4 days ago we were in Doha, and a lot has happened since then. I'm back home in Taipei, and was in Singapore in between. So yeah, it's great, and it was a prosperous and fruitful discussion that we had.
Thank you, and thank you for accommodating that you take this podcast today, and you just landed a couple of hours ago. So I'm really grateful for that. But I'm sure your mind is still very active, and that's why we need to capture all the things out of it for today. But before we start, I would like you, please, Curtis, to introduce yourself and kind of tell people what you do.
A little bit of what I do. So I run the Startup Grind chapter in Singapore. Startup Grind is the world's largest network of startup and entrepreneurs. I think there's probably more than 400 chapters globally right now. And, I look after the Singapore chapter. I've been doing that for about 7 years. And, most of the directors all over the world. In fact, when I met you in Doha, I was landing from Tbilisi, Georgia, and was there with other Startup Grind chapter directors looking at that ecosystem. So I do that. That's kind of, a lot of us do it very much voluntarily. It's not a full-time paying job. For that, I do a lot of consulting work with startups and trying to help founders, particularly getting out of Taiwan. And I also haven't done any investing in a while, but, also kind of, do some things on that side as well with startups, but not like any regular angel investor, I would say. So yeah, I've seen quite a bit, in my time as a Startup Grind director and working with startups. And, I told you some of those stories in Doha. And, I think what we can talk about today hopefully can be really impactful in helping founders, improve just how they go about doing things in their startup and how they communicate that.
That's true. And I'd like to give a shout out to Samir Sorter, who is the Startup Grind director in Dubai. And that's how we got introduced. So I'm happy about that. So let's start. I know our conversation encompassed a lot of things related to startups and supporting founders. And I think this is a very important element because this is where we both connected, that we're really about supporting behind the scenes, the person themselves, other than the venture, of course. Right. And one of the very important elements, which we had mentioned in today's title, is storytelling. Now, I came from a marketing background. I'm all about the brand. I'm all about the brand story and building up the brand equity. So, how do we create a brand story that not just is about the brand and creating brand equity, but more importantly, the perspective you brought on board, which I loved, and it's about how do you storytell for fundraising? And of course, any startup founder is like, I need funds. So let's break that down. Let's kind of talk about first the concept of storytelling for fundraising.
Yeah, and I talked about this because we did a Startup Grind event in Georgia about this. So it's kind of very high level. And I think what a lot of founders, when they're out there fundraising, first of all, and we talked about this in Doha, there really isn't like a dummy's guide to fundraising. There really isn't a playbook that you can just download. A lot of what founders learn about how to fundraise is, trial and error, talking to people that actually have done it, and maybe watching, some things online. I actually tell founders, go watch Shark Tank, because it actually is it actually has a lot of positive elements that you need to have in a
Yeah.
pitch. And the power of story, whether that's in marketing, personal branding, whatever you do, in how you convey that message, can really make or break the connections that you form. And particularly in fundraising, because so much of what
Yeah.
you need to do is connection driven, and you really need to do that in a way that uh, gets people interested in not just the business, but you as the
Yes.
founder,
Yes.
is critically important. In the time that I've worked in startup grind, been on the periphery of investing and fundraising. I've kind of seen a lot of things, and I've started to hone in on kind of like, what are the elements that, founders really need. First and foremost, it's the founder more than the idea. I think I was
That's right.
inverted on that a few
Yeah.
years ago. Oh, it's a great
Yeah.
idea, but if the founders can't communicate how they're going to execute on that idea, then they really can lose people. But great founders that know how to storytell, that actually have an executable idea. It doesn't need to
Yes.
be a world-changing, life-changing idea, but it can
Yeah.
be something that's very, can grow an
Which
actual
addresses the
business.
pain of a certain segment and can
Yeah,
actually come to life and bring in revenues.
yeah, yeah. So it's like maybe it's a new F&B concept, like
Yeah.
restaurants are a dime a dozen. F&B, fast food, fast
Exactly.
casual, they're a dime a dozen. But maybe you have something that fits into the market that serves an unmet need. So if
Yes.
you can communicate that and storytell that, the vision that you have, then that can really be a thing that makes or break things
True.
for founders and fundraising. And then
Yes.
also, what's really impactful, I think, for storytelling is articulating how you get to that exit.
Yeah.
Um, I think a lot of people that hear pitches would agree with me. Not enough founders are really thinking about the exit, and particularly in
Yeah.
fundraising, they're just out there to get funds.
Yeah.
They either to keep going or surviving, or to start like scaling and building, but they haven't
Hmm.
really thought about the exit.
What's
How
next? Yeah.
investors, yeah, what's next? How do investors get their money back? What's the
Yeah.
liquidity event?
Yeah.
That allows investors to cash out. Because remember, at the end of the day, the people you're communicating your story to, it's not charity. You're not running a nonprofit asking people to donate. They're
Yes.
trying to make money, so you need to
True.
articulate the vision for the company in a way that lands on them and hits those receptors on their side, that they understand, okay, I get it, and I can see a path forward on how I
Yeah.
could make money on this startup.
Yeah, and this is very important because, as we said, having a vision is important. You're seeing where the company could grow. They're looking for the
Hmm.
growth, they're looking for the scalability, they're looking for the traction right now. Of course, the founder themselves is a factor, but more importantly, where's this business? How are you getting out of the business, or how are you going to make out your objectives 5, 7, 10 years down the line? And sometimes founders get intimidated by the thought of thinking that far ahead because they're like, I'm still trying to make it now. But that's what you need to communicate in a story to the
Yeah.
investors.
And we talked about this in Doha. I mean, first of all, with startups, like nothing ever goes exactly to plan. There's always
Of
twists
course.
and turns and
Of
curveballs that are
course.
thrown. But
Yeah.
if you have a North Star that you're oriented towards, the ship gets
Yeah.
off course, but you're able to get back on course. That's
Yeah.
really what investors want to see, is that you have a vision that you're executing on, that you can take it to that exit point, or get it to a point where it's just like they could exit the business. One of the things that I think I wish I saw more of in pitches and presentations is, once a milestone is kind of reached, founders saying this is where we would entertain an acquisition or
Mm,
an exit of some
yeah.
sorts, whether that's probably an acquisition, or at this point, if we're not acquired, then we'd look at an IPO or something like that.
Yeah.
So there's I mean, even if it's just, depending on what you want to do, I mean, as long as you can articulate that to an investor, I think, and they can see, a path, they can see the road in front, and they can see the end point and the destination. and how that road could be driven, then you're going to win them over potentially a lot more than if you don't have a powerful storytelling capability in your arsenal.
That's true. And something else that's really important as well, Curtis, which kind of came to me as you were saying that, is you're also communicating the vision and the milestones to the investors, and their role, other than kind of writing you a check, is also to support you. And I know, of course, angel investors are a lot more vested than VCs and
Hmm.
everything else, but everyone wants you to succeed. And when they know
Hmm.
what you're heading towards and that clarity, they could do those introductions, or they also have it on their radar to be able to support you in those milestones.
Yeah, and that's exactly true because when you're talking to investors and articulating this vision, first and foremost, I'm not a fan of like, oh, this is the pitch for the VCs, this is the pitch for like the angel investors, or this is the pitch for
Yeah,
the friends and the family.
yeah,
You really just need to have the same pitch. You need to
yeah,
have the 30-second elevator pitch or even the 10-second elevator pitch in your back
true.
pocket because you never know who you're going to meet. And that needs to be clear and consistent across any type of a person that you're talking to. And so I think, when you're doing that and you have powerful storytelling capabilities, that comes very easy to par that down from like this is kind of like our standard pitch that we would make
Yeah,
to any investor, potential investor, and then this is kind of like what the 30-second or the 5-second or the 10-second one is,
yeah,
in case we bump into somebody at a conference or an event, or
yeah,
in the elevator. So and kind of on that point, um, the investors that you're talking to, we talked about this in Doha. Quantitatively, a dollar is equal, but
yes,
it's the qualitative aspect. So you mentioned about the qualitative elements that they can add.
yeah,
They have a vested interest in your success because they want a good outcome.
of course.
So there's alignment there. So yeah, they will help you. But the objectives of some investors are very different, and it really is dependent on the part of the world that the investors are in. Like angel
Yeah,
investors, I would argue in Asia, for instance, in certain parts of Asia, are much less like grow at all costs. They are a little bit more play it safe.
yeah,
And that kind of runs counter to what a VC is, which is, we want to see you growing and scaling and have parabolic growth at some point so that you can
mhm,
hyperscale and turn into a unicorn or
yeah,
whatever, or something that can, contribute to the success of the fund that they're investing from. So,
yeah,
the objectives of the investors, everybody wants to make money at the end of the day, but there's a lot of different ways as to how. And
yeah,
so, and also the growth metrics that they're looking at. So, powerful storytelling, when you're pitching and fundraising, it's very much like dating. Like, I know it's a little bit of a cliche analogy that people say, but it really is true.
I use that a
You're
lot. You're
yeah,
building a relationship.
you're building a relationship, and it's a long-term thing. This is not a
Yeah,
a short-term casual, like, okay, I got the check, bye.
yeah,
That
exactly.
was quick, that was easy, and we got money out of it. No, this is a long-term relationship. And being strategic about that is important, and powerful storytelling in your pitch deck is really important too. Because if you're doing that well and you're telling the story properly and your pitches sound succinct and concise, then you're going to start attracting the right type of investors that meet your objectives. And if you clearly articulate those objectives
Yes,
consistently, then you're going to wind up finding the type of investors that you want. So
exactly.
it's really, I think, really really important, to be deliberate about that. Fundraising is hard, I get it. It's hard to look a check that's for 10 or 20, $50,000, whatever it may be, and you're kind of struggling along in the early days of a startup, and thinking,
To be picky
well,
about
short
it.
term, yes, this is great.
Yeah,
Yeah, you
yeah,
can't really be picky and choosy, but also at the same time you need to balance it somehow. and
that's
and
true.
that's something where it's really really tough for founders, I think. And it's podcasts like this, and it's also going and listening to founders who have gone this road before share
Yeah,
those stories and how they did it. and particularly like, the ones that became unicorns or whatnot, those founders are very, very good at saying like, yeah, in the early days, like we had everybody doing this or whatever it may be. They might have been able to be picky and choosy. They might not have been able to. So, it's such a tough process, and that's why so many startups fail, is because it is such a windy, twisty road that has so many
That's
turns,
true.
and you can fall off at any time.
But what you mentioned here, Curtis, is really, really important. And that's something I keep talking about to everyone I'm mentoring and, across any platform, is finding that aligned investment.
Hmm.
And as you said, the power in storytelling is you share parts of you, parts of your vision, parts of your venture and where it's headed. And you want to connect with an investor that is aligned with your values, with your vision, with your personality and everything else, because
Yeah.
the impact, then the ripple effect of you collaborating and working together is a lot stronger than just viewing every person that passes you as a potential checkbook. And they're not.
Yeah.
You want to create, as you said, it's a long-term relationship. You want to build it on trust and common values and ethics and vision and passions and everything else that could appear like fluff to a lot of people, but in the long run it does have a lot of return on that investment as
Yeah.
well.
And startups and founders need to be able to articulate in that storytelling why their company is a good fit for their portfolio of startups that fund or VC firm is investing in.
Yeah.
Like,
Yeah.
do as much homework as you can. Try to, comb their website for their investment philosophy thesis. Try to talk to other founders if possible that are, you know, in the portfolio of that VC firm if you
Yeah.
can. Warm introductions always go a long way too. I mean, you really, just have to really get out there, I think, and do that. I'm not a founder myself. Like I said, I've been on both sides. I've seen pitches, I've heard pitches,
Yeah.
and I've coached some
You're in the
founders.
ecosystem and on the investment side as well.
Yeah, and so I haven't been a founder myself pitching, but this is just kind of a consistent theme that I say is, look, a lot of founders that come from sales backgrounds, like I did media sales, so you have two of these and one of these, use it proportionally in sales. So
Yeah.
2/3 of the time, you really should be listening in sales, like what's the objective that the client wants to achieve, and then you figure out how you fit into that objective. Very similarly, I think for investors, it's it's the objective is not to make money. That everyone wants to do that, but
Yeah.
it's really deeper than that. That's very surface, and
Yeah.
the depth of that is what type of returns are they looking for? What, like, how fast do they want to get to exits?
Yeah.
Are they you can just kind of like, how many
What
checks do
kind of
they write?
impact are they trying to
What kind
create
of
and legacy
impact?
work?
Yeah. Yeah. Is there a social impact that they're looking to
Yeah.
do? Are they maybe more socially conscious? There's all, so that's why I say a dollar is not equal. It's,
Yeah.
it's kind of like a dollar bill that's like, wrinkled and crumpled up and everything, is just as good as a very shiny, clean dollar that was printed last month. They're
Hmm.
quantitatively the same, but, qualitatively, one's very different. So,
Let's
that's
dig a
why,
little deeper into dollars are not equal, because
yeah.
when you said that, I'm like, okay, yeah, that's interesting. We spoke about raising from FFF first, so friends, family, and fans, I call them.
Hmm.
And then we have the angel investors, and then we have the VCs. But as you said, each of this type of funding that you get is not equal. It's not necessarily about the numbers.
Yeah.
Dig a little deeper into that concept, how you see it.
Well, all VC firms are not created equally. A lot of the early stage ones, like I'm a mentor at Orbit Startups, and they do a
Yeah.
great job about, I think, on all the help that they provide to their portfolio companies after investment. So,
Mhm.
you look at some of the early stage ones. You look at ones that have programs like YC is probably the most well known one,
Yes.
and being an alumnus of that and all the doors that it opens up afterwards. Um, so a lot of the early stage one, there's a lot of intangibles that are in addition to the dollars.
Yeah.
So there's a whole bunch of qualitative intrinsic value that you unlock with some of these VC firms. And then, perhaps later on, you have ones that are, you know, they're not, they don't really necessarily have a hands-on approach, but they could have sources of financing for you,
Yeah.
because they focus on, like, the one I always kind of see is hardware startups, very
Mhm.
capital expenditure heavy.
Yes.
Everyone loves SaaS because capex is so low,
Yeah.
in most cases. But hardware is
Second. Yeah.
it's a long slog,
Yeah.
and a lot of VCs that doesn't fit into their thesis. But there are investors out there that will do that and have, sources of financing that they can, alternatively connect you with. Like if you get a big purchase order, that is a purchase order is such a powerful thing for a hardware company, because you
That's true.
can go get capital to produce and execute on that purchase order in
Yeah.
most cases. And there's even some startups that have actually come out looking to help other startups on the financing side of things.
That's true.
um, so I think there was an article in Tech in Asia maybe a few days ago about venture debt. Like there's a whole host of different ways, that a dollar can get into your bank account. But what that dollar represents, is it equity, is it something else, is it debt? So you really need to also think about that. I think if you're a founder, is you know just what are you going to give away in terms of, from your company, for what you're looking to raise, and also what the instrument is. We don't want to get too financially technical, I guess, in
Yeah.
this, but there's all sorts of things out there: convertible notes, safe notes, straight up equity. Venture debt is something. If you watch Shark Tank a lot, I think one of the sharks likes doing those sorts of, or royalty deals, or
Yeah.
whatnot.
They
So
always
you
have
know
their style.
yeah, so so you have all sorts of VC firms and different objectives, and then you have all sorts of financial instruments and tools. And we're not giving financial advice here, in this podcast, but as a founder, you really need to look at those things, because there's all different types of mechanisms and tools out there. And what sort of help are you looking for? If you're really looking for a hands-on investor, you know and you don't discuss that before you sign the paperwork, everyone's expectations should be aligned. And that goes back to storytelling, what you're
Yeah.
looking to do, and also communicating the types of investors that you're looking to bring on board. Because
Yes.
if an investor says, like, I like what you're doing, doesn't fit into my thesis, I wish you well. Yeah, you're gonna be disappointed, but that might be a good thing, because it just means it's not a good match. It's not, and
Yeah.
so it wouldn't be a good long-term relationship. So
Yeah.
I know this is very kind of surface level stuff, um, and it's always great to talk to founders that have raised and gone through a few rounds, and maybe they've
Yeah.
exited, that can actually talk about and speak to this. What the early days were like, and we do that a lot at Startup Grind in the fireside chats that we do. So
Yeah. I know that.
yeah,
Okay, so we don't have much time left because
yeah,
again, I respect you just flew in. But
yeah,
I want to touch on risk. And I know that, as part of our conversation, we were talking about not all risk is equal either. And
yeah.
generally speaking, startups it's a risky business. Success rate is
It
not
is.
guaranteed at any point in time. That's if you are risk averse, then maybe an SME would be the route you will take rather than a startup. But
Yeah.
let's talk about that part. The not all risk is equal when building your startup.
Yeah, just like dollars quantitatively, not all dollars are the same because of where they come from. Um, all risk is not equal. And I've seen, I'm in Taiwan, and I've talked to a couple of Taiwanese startups, nothing that's a representative sample size, but a handful. And I've been in Singapore. I've been involved in the startup grind ecosystem, so I think I'm qualified to speak on this. the general theme that I've seen from the ones that have gone on to have success is that they were very calculated and measured in the risks that they took, meaning
Mm,
that they realized that, no startup ever became a unicorn by playing it safe. Like everyone that's an experience in the startup world, particularly on the investor side, I think knows that. I think a lot of
mm.
founders don't know that though. But you're never going to get anywhere by playing it safe. Even in life, you
Yeah.
need to take certain elements of risk. There's always that risk return debate and negotiation that you have in your head. And what a lot of startups, particularly some of the ones that I've know, known personally, is the risk that they take is so like we'll take that risk, but it's not going to impact the business if it fails in a
Yeah.
significant way. And it's usually like, well, then it's not going to impact much on the upside if it goes well for you.
Yeah.
So, you have to take calculated risks. And VCs in your storytelling and in your pitching want to be able to see how you approach risk. I think investors like
Mm,
seeing that. They like to see what the deliberation process is on a person's psyche in terms of how they approach risk. There is
mhm.
reckless risk, which is you're just kind of betting the farm, and it's like going to the casino and putting all your money on black
Yeah.
or a number in roulette, which is even worse odds.
Equivalent of we
Uh,
work in real life. The story
yeah,
owned.
and yeah, and there's always that risk versus return thing, and you
Yeah.
have to remember on the VC side of things, they're taking risk too. So you
Sure.
know, fundraising in startups is like four-dimensional chess. I like to say
Mhm.
it's
Yeah.
the somebody else is VCs are playing risk and reward scenarios out. Startups are doing that. Employees are doing that as well. So you have all
Definitely.
these different
Mm.
elements to manage, but what I have seen is that, the founders that really get it realize, okay, there are smart calculated risks to take where they game things out, they do their homework, they run the numbers and everything, and they say, we're going to go here. And
Mm.
yeah, it's a risk, but we think it's a risk that if it pays off, the upside potential for growth or whatever it is really good. And I think VCs like seeing that. They want to see founders that take a bit of risk and do it in a smart way. And I would go on to argue that investors, particularly seasoned ones, would just from my discussions with VCs, would rather give money to a startup that has a well thought out plan, has done the homework, and says we're going to take this course of action, which carries a bit of risk, obviously, but versus one that just plays it safe. Because if you play it safe, you'll just have like menial growth, and you'll be in
Yeah.
perpetual SME land most likely. And that's kind of like
That's
hell
it.
for an investor, to be honest, because it's like,
Yeah.
well, you haven't died. You're like a little mom and pop shop. You make a little bit of
Yeah.
money and stuff, but I'm never
Yeah.
going to get my money out.
Yeah.
And that's just almost worse than like, hey, these guys gave it an honest shot. They gave it their all, 110%. It was well thought out, but the market wasn't ready. The timing wasn't right. But you know what? Like they gave it a good shot. So say la vie. That's fine.
And what you're saying is really valid because, and I think I shared this with you. I believe in as informed as possible decisions. You can
Yeah.
never make a fully informed decision because we know the market shifts. A lot
COVID.
of it, yeah, that
Yeah.
too. I keep bringing it up all the time. I'm like, maybe I'll stay
Yeah.
away from it, but it is. It's a very live example, and a lot of
Yeah.
companies are still trying. I don't want to say recover, but adapt since then.
Yeah.
One of the main things was if a company was doing great with a minimal digital footprint and COVID hit and lockdowns started rolling up across the world, that
Yeah.
company went down the drain very, very quickly.
Yeah, you,
And
you
and these
saw
are
a
the kind of
lot
things
of
where,
fire sales then too, like,
yeah,
because people saw opportunities like this thing won't last forever. These guys need money and they got a great product. We can buy it cheap right now.
yeah,
So that happened a lot, and but that was just unpredictable. Something that nature did that people
yeah.
didn't see coming. So Yeah,
But from if we go to the other side, something not as extreme and as global as that, there are shifts happening on a daily basis. So the
yeah,
essence is, yes, be a risk taker. You don't have to go all out and kind of risk it and kind of bet the company away at
yeah,
one deal. But what you're looking at is, how much information and knowledge do I have today to move the needle forward? And I think that's the
yeah.
important part. Just
That really
maybe
is the
with a
important
startup
thing.
founder, you want a bit more of moving the needle rather than, as you said, kind of the very small steps that just keep you afloat, but they don't actually help you grow or scale.
Yeah, and I think if you want to look at great examples, with risk, the other thing too is life in the world is going to throw curveballs at your business, and you have to be able to hit them.
Yeah.
And if you don't, it could do you in. And I think one of the best examples is, we always talk about pivoting and stuff. Listen to what the market tells you. And that's another podcast for another time about,
Yeah.
founders and egos and getting set in their ways and not really listening to the market and
Sure.
what the market's telling you. I think the best example is Netflix. When Netflix
Yeah.
started, I was in college back then, and it was this really cool thing. Like everyone's like, hey, you can get DVDs in the mail and it's all done through the
Yeah.
web, and you send it in, they send you another one. And you're like, that's fantastic.
Yeah.
And they, whoever and however it went down in the hallways of Netflix when they pivoted to streaming,
Yeah.
like if they don't do that, they're not the company that they are today. And that was, probably I'm just hypothesizing here, but
Yep.
that was a risk decision that was made,
Definitely. Yeah.
and that was probably a very informed decision by external data and having a long range radar, seeing where trends are going, and
I've listened
just
to
catching it, timing.
Yeah, I've listened to actually the co-founder. I forgot his name right now, which is not nice. But the
Yeah,
co-founder of Netflix, I listened to him. He was on an interview with Stephen Bartlett of Diary of a
yeah,
CEO, and he was talking about that. He's like, at that time they were competing with Blockbuster,
yep,
and they were making billions of dollars revenue per year, turnover and everything, and they had just made $50 million and they were even at a loss. But that decision, because like they can see something way down the line, that Blockbuster, when they finally, I think they were trying for 18 months to have a meeting with them, possibly get acquired or something,
yeah.
and they
I,
laughed
I
them
remember
away.
reading that too.
They laughed them
Yeah,
out of the office. Blockbuster went bankrupt. I think it was like 2 years later, because they're just, no, the streaming is just such a small business. We're not going to even focus on it. Let's keep
yeah.
doing what we're doing.
Yeah, I remember reading that in bits and pieces. And that is, I believe that's exactly, you're recounting it exactly right, because they've definitely gone on the record and talked about this, because I remember reading about it. But it really is interesting because they were a disruptor in that sense. There was an incumbent market leader,
Yeah.
Blockbuster, which is which did eventually go into DVD rentals. They were
Yes.
playing catch up at that point,
Yeah.
and Netflix was already ahead of the curve. And the fact of, and then just pivoting into streaming, and the amount of capital that they needed and turning into a studio and everything, and then now winning awards and everything for what they produce and great content. So it's a great case study. There's probably case studies that have been done on it that I can't remember off the top of my head, but they're
Yeah.
probably out there about
Yes.
this. And that vision that they had, and the ability to pivot, and it was a risk to take. But quite commonly we hear across the startup grind world is the amount of risk that some of these founders take, in terms of pivoting the business or making a bet on something, and shifting the business, versus playing it safe. And in some cases they take a risk that actually, if it doesn't work out, might kill the company. But they also
Yeah.
realize that staying where they are could eventually kill the
Will kill
company
the
too.
company also too. Yeah.
So, so you have to weigh all those things out. And if you're a play it safe sort of person, don't like taking risks, don't like, um doing those sorts of things, it's going to be hard for you as a founder to fundraise, I think, or to actually do a startup. So,
Yeah.
SMEs are fine. Like, if it's just friends and family and, people that are just lending you money to do a small, medium enterprise, that's different. But the moment you take like venture money,
Yeah.
your business has to have uh, a lot more risk elements to get to the growth metrics that VCs are looking for.
That's true. Curtis, thank you so much.
That was
Another
my pleasure.
enriching conversation. I
I hope
can't
it
leave
was
you without
useful for
asking
everyone.
you. I hope so. That we're getting, thank you guys. We're getting great comments on LinkedIn. So people are
Yeah,
finding value. I'm really happy with that.
I'll have to go look at
Um,
them afterwards. Like I
yeah,
don't have it open right now, but I mean,
I'm
it's
trying my best. I'm like, they don't always
yeah,
come through because we are on StreamYard, but we got a
yeah,
couple through. So thank you. Um, I can't leave you without asking you the final question. And this
sure,
I ask, I try to remember to ask all my guests when I have them. Empowered to grow and empowered to grow in business. How does this
yeah.
phrase resonate with you on a personal level?
I think it's that's a good one. I think it's you know, recognize, like, when I feel empowered to grow or to actually go out and do things, it's number one, it's looking yourself in the mirror and realizing that, I can do this. I do have the confidence to do this and go
Mm,
out there and be this. And there are people out there that are genuinely encouraging me and interested in my success. And people that have known me for a long time would tell you, I think that, I do like seeing people succeed. And when I'm giving encouragement to founders, like, I'm giving it to them very straight. So if I don't think an idea is good, I'll diplomatically tell people that.
yeah,
Um, but that's rare because there are great ideas out there, and there's great founders out there, and some with really great ideas that, I really want to see them succeed. And I think as long as you have people out there that are genuinely invested in your success, surround
mm,
yourself with those people, because you'll draw sources of energy and inspiration from them. They will give you that encouragement, and they will empower you to grow in your business. And growth is also uncomfortable. So if you're empowered to grow, you might have a little bit more comfort to take those risks, not just in life but in business. And realizing also that nobody's perfect. Nobody's perfect.
yeah,
Everyone in this world is going through something. Some might hide it better than others, but don't try to be a perfectionist either, because
yeah,
a lot of the time, growth comes from failures. And we talked about that in Doha. Like,
yeah,
if you're not failing, and that can be like a task, a business, something else,
yeah.
then you're not growing. So a lot of the times, I think we just need to realize that all of those things should empower us to keep us going forward.
Thank you so much, Curtis.
I
A
hope
lot
that
of
answers
value
it.
added today. It definitely answers. And it's
Yeah,
also a reminder to, as you said, because we're not all perfect and no business is ever perfect, it's a reminder for us to be kind to ourselves and to others because we don't
yeah,
know
and
what
be humble. Yeah, and be
that.
humble, and that's also something in storytelling. And I think one thing I didn't mention is it's okay to not have all the answers in your pitches.
Yes.
Because you
Yes.
know what? Seasoned investors can spot BS a mile away. And they can
Yeah.
also spot when you are just making something up to just fill the void. So, being humble and admitting, it's okay to admit if you don't have the answer to that. But if you can articulate how you would go about solving that problem or
Mhm.
taking that into consideration, that is way better than just making stuff up. So,
That's
it's
true.
okay to not have all the answers.
That's true. And I always keep reminding myself of that because it's not
Yeah.
good.
Yeah,
Thank you
know
again,
what
Curtis.
yeah, you know what you know, and you know what you don't know, and I certainly do that as well.
And that's
So,
okay. That's
and it's
okay.
okay. Yeah. So, yeah, but I hope it was helpful and insightful for everyone.
It's been great.
Um,
And I hope
yeah,
people get a lot of value from our conversation today. You've been amazing. To everyone who's watched this and joined us today, thank you. I hope you did get as much value as I did. And I know, Curtis, this is not going to be our last conversation. I'm sure there will be more.
I sure hope not.
Maybe get Samir and other Startup Grind people on and Founder Institute and kind of have a party online.
I'll be in Dubai in a few weeks. So Samir and I will have a catch up.
I'll try my best. If I can make it in person, it will be great. If not, we'll have it virtually.
Yeah, sounds good.
Okay, great. Thank you, everyone, for joining us. I hope you got a lot of value today. And as always, I wish you love, abundance, and prosperity. And I'll see you next time. Bye for now.
Bye-bye.
Thank you for listening to the Empowered to Grow podcast. I'll catch you on the next episode. And until then, know that empowered you empowers others. Love, abundance, and prosperity to you all.